Here's a number the mortgage broker never shows you. $4,367. That's what a $500,000 house actually costs you every single month. Not the payment they quote you, not the number on the listing, the real, all-in, nothing hidden monthly number when you add up everything the bank conveniently leaves off the paperwork. But here's what nobody talks about. That number isn't even the dangerous part. The dangerous part is what happens the morning after you get the keys. Because the moment you sign those papers, something shifts. Your career stops being yours. Your savings stop growing. And every financial decision you make for the next 30 years gets filtered through one question first. Can I still make the mortgage? My name is Marcus, and in this video, we're going to go somewhere most finance content refuses to go. Past the purchase price, past the approval letter, and straight into the financial reality of what owning a $500,000 home actually does to your life. The math is going to make you uncomfortable. That's the point. Let's start where every home buying conversation starts, the mortgage payment. You find a $500,000 house. You put down 10%, that's $50,000, which for most people is 3 to 7 years of disciplined saving. Your loan is $450,000. At 6.5% interest, your monthly principal and interest payment lands at approximately $2,845. That's the number the mortgage broker highlights. That's the number the real estate agent points to when they say, "You can totally afford this." That's the number that gets people to sign without reading what comes after it. Now let's build the actual number, the one that hits your bank account every single month, whether you're prepared for it or not. Property taxes first. Depending on where you live, you're looking at $4,000 to $8,000 per year. That works out to roughly $500 per month on the conservative end. And that number is not locked in. Property taxes rise with your home's assessed value. In markets where homes appreciate quickly, that bill can jump significantly every couple of years without any warning. Homeowners insurance, $250 to $350 per month. This has gotten brutal in recent years. Climate events have driven premiums up dramatically. Insurers have pulled out of entire states entirely. The ones still writing policies are charging far more than they were 3 years ago. If you're in a flood zone, fire corridor, or coastal area, that number can easily double. PMI, private mortgage insurance. Because you put down less than 20%, the bank charges you a monthly fee for the privilege of having lent you money you didn't fully have. This runs $200 to $400 per month and provides you zero benefit. It protects the bank against the risk of you defaulting. You pay this until you've built 20% equity in the home, which, at current prices and rates, takes the average buyer 7 to 10 years to reach. Maintenance reserve, $417 per month. Every financial expert agrees on the 1% rule. Budget 1% of your home's value annually for repairs and upkeep. On a $500,000 house, that's $5,000 every year sitting in reserves. This is not extra caution. This is the water heater dying on a Sunday night, the roof leaking in November, the air conditioning unit failing in the middle of July. These things happen, and they happen on their schedule, not yours. Now let's total it all up. Mortgage, $2,845. Property taxes, $500. Insurance, $300. PMI, $300. Maintenance reserve, $417. Total monthly housing cost, $4,362. Not $2,845, not the number on the loan estimate. $4,362 every single month before you've bought groceries, filled your gas tank, or paid a single other bill that keeps your life running. Financial advisors use the 28% rule. Your total housing costs should not exceed 28% of your gross monthly income. To keep $4,362 within that boundary, you need to earn approximately $187,000 per year as a household. The median household income in America is $84,000. The median American household would need to spend 62% of their gross income just to cover the real cost of owning a $500,000 house. That is not tight budgeting. That is not a sacrifice worth making. That is a mathematical impossibility dressed up as a normal life milestone. Now, before you reach for the equity argument, yes, you are building equity. That is always the response. Renting throws money away. A mortgage builds something that eventually belongs to you. Every payment is an investment. Let's run those numbers honestly, because the equity story sounds far better than it actually performs. In month 1 of your $450,000 loan at 6.5%, your $2,845 payment breaks down like this. Approximately $2,437 goes directly to interest. Only $408 reduces your actual loan balance. You hand the bank $2,845. The bank keeps $2,437. You keep $408. Over your entire first year, you pay roughly $29,000 in interest. Your loan balance drops by about $5,100. For every single dollar of equity you build in year 1, you are handing the bank $6 for the privilege of borrowing from them. That is what the equity argument is built on in the early years of a mortgage. Then add closing costs when you purchased, typically $10,000 to $25,000 gone permanently the day you signed. No equity built, no return generated, just evaporated into title fees and lender charges. When you eventually sell, because the average American moves every 7 to 10 years, another 5 to 6% in real estate commissions disappears before you receive a dollar. On a $500,000 sale, that is $25,000 to $30,000 removed immediately from the top. Run a full 7-year scenario. Your home appreciates at 4% annually, and after 7 years it is worth approximately $658,000. That looks like a $158,000 gain, and people point to that number as proof the investment worked. But your total non-principal costs over those 7 years, mortgage interest, property taxes, insurance, maintenance, and transaction costs on both ends of the deal run close to $200,000. Your real net return after 7 years of ownership is negative. The equity is real. The guaranteed wealth-building narrative permanently attached to it is a sales pitch, not math. Now let's stop using abstract numbers and put a real household inside this scenario. Meet the Andersons, 2 working professionals, combined household income of $160,000 per year, well above the median, upper middle class by any reasonable definition. They have been responsible their entire adult lives. They saved $55,000 for a down payment over 5 years of real sacrifice. By every cultural and financial measure, the Andersons are exactly the household a $500,000 home is supposed to serve. After federal taxes, state taxes, FICA contributions, and a modest 401k that every financial advisor has told them is non-negotiable, they take home approximately $9,500 per month. That is their real money, the number that arrives in the bank account and has to stretch across their entire lives. Subtract the $4,362 monthly housing cost, and they have $5,138 remaining for everything else. 2 car payments because they both commute to the jobs that qualified them for this mortgage, $800. Car insurance for 2 vehicles, $250. Gas because nothing near a $500,000 house in their market is walkable, $300. Student loans because the degrees that produce the careers that produce the income that produce the mortgage approval don't pay for themselves, $600. Health insurance premiums their employers only partially cover, $400. Groceries for 2 adults making reasonable choices, $700. Utilities for a larger home, electricity, gas, water, internet, phones, $450. Now they have $638 remaining. No clothing budget, no savings for their kids' activities, no car repair fund, no emergency savings, no entertainment, no dining out, no travel, no financial cushion for anything that goes wrong. $638 per month standing between the Andersons in their first financial crisis.
And these are not careless people. They did not make reckless choices. They followed every rule society gave them. Quality educations, stable professional careers, years of disciplined saving, and they are now one car repair away from credit card debt and one unexpected job disruption away from missing a mortgage payment. This is what house poor looks like from inside the house. Not dramatic, not visible to anyone on the outside, just a constant grinding, low-frequency financial anxiety that becomes the permanent background noise of everything they do. Then, the house itself creates the crisis, because houses are physical structures with mechanical systems operating on their own timeline. They do not check your account balance before they break down. HVAC system replacement, $8,000 to $15,000. New roof, $10,000 to $20,000. Water heater, up to $3,000. Sewer line failure, $5,000 to $15,000. Foundation issues start at $5,000 and escalate quickly from there. None of these are genuine surprises to anyone who is being honest about homeownership from the beginning. They are scheduled, predictable costs of owning a physical structure. They feel like ambushes only when you have $638 in discretionary income and nothing held in reserve because there was simply nothing left over to reserve. So the Andersons finance the repair. They open a home equity line of credit. They borrow against the asset in order to maintain the asset. The thing that was supposed to be building their wealth has become the collateral securing their basic survival expenses. And because small problems grow into large ones when you cannot address them immediately, the minor roof leak becomes structural water damage, which becomes mold growth behind the drywall, which becomes a $25,000 remediation project instead of the $400 repair it would have been several months earlier. Deferred maintenance does not save money, it charges compound interest on the delay. There is one more cost that never appears on any mortgage estimate or financial spreadsheet. It may ultimately be the most expensive cost of all. The cost to your freedom. From the moment that mortgage exists, every significant life decision runs through a single filter. Can we still make the payment? A better opportunity appears in another city. $30,000 more per year, better trajectory, stronger future. You cannot take it. Selling in a soft market means losing your down payment. Running two housing costs through a transition period is impossible given your current cash position. So you stay in a role you have outgrown, in a city you are ready to leave because the house made that decision for you without your consent. Your company begins restructuring and you want to leave before they push you out the door. You cannot. You need every single paycheck without interruption. You sit at that desk and absorb every bad management decision, every toxic culture problem, every promotion that passes you by, because missing one mortgage payment starts a clock that ends with your credit destroyed and your financial stability gone. You want to build something of your own, a business, a creative project, any path that requires a period of lower income while you establish it. You cannot. The mortgage does not recognize sabbaticals. It arrives on the first of the month, mechanical and completely indifferent to your circumstances. Financial experts describe this condition as being illiquid. Your wealth exists theoretically in the walls of your home, but you cannot spend it, cannot access it when real opportunity arrives, cannot deploy it when you genuinely need it. You are asset-rich and freedom-poor at the exact same time. The house was supposed to be the foundation supporting a better life. At current price levels and current income levels for most American households, it becomes the ceiling preventing one. Here is what the honest alternative produces when you run the real numbers. Instead of buying the $500,000 house, you keep renting at $2,100 per month. The gap between that figure and the $4,362 all-in ownership cost is $2,262 per month. You invest that amount consistently every month into a broad market index fund, returning 8% annually on average. After 10 years, you have $413,000, liquid, accessible, not locked inside walls, not dependent on finding a qualified buyer at the right moment in the right market conditions, available to you whenever you need it for whatever purpose serves your life best.
The person who bought the $500,000 house has built roughly $80,000 to $110,000 in equity over the same decade, carries consumer debt accumulated from maintenance emergencies, holds minimal liquid savings, and has spent 10 years making every major life decision through the narrow filter of mortgage survival. The renter who invested the difference built more actual wealth, preserved more genuine freedom, and kept significantly more options available. Nobody frames it that way because nobody in the home buying transaction gets paid when you walk away from the table. There is a version of homeownership that genuinely builds wealth and makes your life measurably better. It is real, but it requires the actual underlying numbers to support it: the income, the down payment size, the monthly margin, the financial stability. When all of that is genuinely present, buying a home makes complete sense, and you should move forward without second-guessing yourself. When it is not present, when you are stretching beyond what the math honestly supports because a bank approved you, or because culture says you should own by now, or because you are exhausted from renting and you need this to be the right decision, you are not buying a home, you are buying a 30-year financial sentence. The approval letter and the affordability calculation are two entirely different documents serving two entirely different interests. The bank determines whether you will make the payments. You are solely responsible for determining whether making those payments makes your actual life better or smaller over time. Run the complete real number, not just the mortgage payment. Everything: mortgage, taxes, insurance, PMI, maintenance reserve combined. Find where that total sits relative to 28% of your gross monthly household income. If you are genuinely there, move forward with full confidence. If you are not there, that is not failure. That is honest, accurate information. Use it constructively. Save more deliberately. Explore different markets or price points. Wait for better entry conditions. Invest the difference in the meantime, and let time and compounding work in your favor while you wait. There is no trophy awarded for buying a house that makes you financially miserable. There is no prize ceremony for being house poor. Real wealth is margin. Real wealth is having genuine options. Real wealth is the ability to make the decisions that actually shape your life from a foundation of stability rather than a position of desperation. A $500,000 house can absolutely be part of that story. Just make sure the math honestly confirms it before you put your name on the paperwork. My name is Marcus. Stop letting the banks and the brokers make this decision for you. Do the math first.